Greg, thank you for coming.
Eric, good to be here.
Greg Fleming is running Rockefeller Capital Management. Some of you here may know him from his former lives running wealth management at Morgan Stanley. He was the head of the investment bank at Merrill Lynch. He took BlackRock public once upon a time. So Greg has seen a great deal, and he brings, yes, I think it's fair to say, a unique perspective.
Thank you, Eric.
And we're interested to know a little bit more, Greg, about exactly what you're doing at Rockefeller and how things are going.
Well, Eric, it's good to be here and good to see you again. At Rockefeller, we're focused on high-end wealth management primarily, but in a unique model. So our family office is Rockefeller Global Family Office, which goes all the way back to 1882, when it was originally the family office of the founder of the Rockefeller family, the first generation John Rockefeller Sr. It became a multifamily office in the 1970s. We bought it about 15 months ago in partnership with the Rockefellers. We renamed the firm Rockefeller Capital Management, and our wealth management business is Rockefeller Global Family Office. And Eric, you've heard me say this. We think we have a unique model. We're a small firm, but with a best-in-class brand, and we're looking to help our clients across the full range of what they need assistance on. So yes, we do asset allocation and investments, but we also do everything else in the family office. We'll help with bill pay. We have trust companies. We help with liabilities. Whatever the client needs, the high-end family needs in the wealth management space, we want to be there for that, including, and this is a unique part of our model, investment banking. We have a strategic advisory business alongside Rockefeller Global Family Office, and many families own businesses and are looking for advice on businesses, so that's been a terrific synergy for us with our clients.
Your clients have a lot of choices. Who do you see yourselves as trying to take business from?
You know, what's interesting is that we're very focused on just one part of the wealth spectrum. So we want to work with wealthy families and individuals. We look at the single family office space with families that have assets of 50 to 500 million. That's a difficult space to do it yourself. And we think we're particularly well equipped to help families of that size. There are lots of competitors out there. It's a very competed space. So there's major brokerage firms, there's private banks, there's RIAs, there's trust banks. We think with the model that I talked about, where we provide comprehensive advice to our clients, including investment banking, to the many clients that have businesses that they own, we can bring something that nobody else can really bring to bear. So there's lots of people, lots of firms out there and lots of competitors, but we think we've got a unique space.
Greg, to the degree that you've been successful attracting advisors who are able to bring their clients and, of course, their client assets with them, where have they come from?
They've come from some of the large firms who on the high end are really offering or trying to offer family office type services. We've hired from firms that have a history in working with wealthy families. Again, more at the larger firms.
Now, are these commercial banks? Are they trust companies?
It's more some of the bigger firms like a Merrill Lynch, an ACO and people like that. But the reality is that we think when we look at the spectrum of competitors, we're small enough to bring high-touch service and great content. We put in place a terrific leadership team with great experience over many years on the technology, operations, compliance, field management. And because of that, we've been able to hire best-in-class private wealth advisors and client advisors from the types of firms you're talking about, Eric. They know with this brand and our leadership team that they can offer differentiated services to their clients. So we don't just talk about the investment banker and the private wealth advisor working alongside each other. We make it happen. In a big firm, and I've been at some terrific big firms, you have thousands of people on both sides. So trying to bring that high-touch service to the client, to the family, where you actually have a experienced, trusted investment banker in the room with the private wealth advisor, that's very hard to do. We think, and most small firms don't even try. They don't try to bring the investment banking. The big firms try, but they have a hard time connecting. We're in that space with the family office history too. we've done this for families for many years at Rockefeller.
I'm curious to know, is it getting easier to dislodge advisors and assets from the big wirehouse brokerage firms, the Merrill Lynch's, the UBS's, the Morgan Stanleys, for example? And if it is it getting cheaper or more expensive?
I would say for us, I don't know whether it's getting easier, but we can definitely do it because we have this unique model. And our private wealth advisors and client advisors coming from firms like that, when they see how we operate, I'll give you an example, obviously on a no-names basis, but we have a client whose wealth, one of our private wealth advisors has worked with for years. The individual is a CEO in his family. He is the CEO of a private company. We're now helping him on the investment banking side, and he knows that we're trying to give him the best advice. He can really trust us because he's already a client. When we bring these private wealth advisors and client advisors to Rockefeller, and they have that brand and a veteran, experienced, talented leadership team and this business model, they're energized by it. And so we've got a lot of inbound now, Eric. We've hired some terrific, talented people over the last 6 or 12 months. But now we have many private wealth advisors, always on the high end. We're not trying to be mass affluent. We're trying to take care of families that have significant assets. But we're trying to take care of them on investments and on everything else, including if they own a business investment banking. We get a lot of inbound calls now from private wealth advisors.
Where do you stand on the asset building front?
We're doing well. When we bought the business in March of 2018, we had about 18 billion in assets, and I think by the end of the year we'll be close to a double on that.
North of 35.
Yeah.
There are two kind of competing narratives at work in wealth management, and some of this doesn't impinge upon what you're doing, but some of it might. And it kind of goes like this. There's a firm like Morgan Stanley, where you used to work, where your friend James Gorman is still the CEO, and whom people think got it right? He bet on wealth management, and the stock performance would suggest that that was the right move. But people are questioning the durability of that success because at the same time, you see groups of, and this is the other narrative, you see groups of financial advisors breaking away with billions of dollars in client assets and setting up as RIAs on platforms like Dynasty. So which is it? Is the move to wealth management by large firms like Morgan Stanley, or doubling down, if you will, still a durable, profitable, successful model, or is it vulnerable because of the advent of the kind of technology that allows RIAs to access compliance, trading, portfolio management functions on an independent platform?
It's a great question, and the answer, I think, is both. So Morgan Stanley's business model with the institutional business and the wealth management business alongside each other, I spent 6 years there, and I think James got that business model right coming out of the credit crisis. And I believe that wealth management remains, I always say this, the best form of financial intermediation. It's been a business over the 30 years that I've been in this industry that trades at a higher multiple. It's recurring revenues, attractive margins, relatively low capital investment. This is a good business within financial services. At the same time, particularly for high-end clients, the ability to bring the high-touch service, to help them with a cross-section of all of their needs, and to do that on an efficient day in and day out basis where they can trust it, where it's not a big firm where you're trying to bring somebody in from a different part of the firm and introduce them to the client the first time. That's tough to do. So I think you can bleed assets, particularly on the high end, but have the core business model still be a good business to be in if you're a big firm.
Those assets on the high end key to maintaining that pre-tax profit margin?
I think they're important, and I think that's one reason why all the big firms are competing to try to hold on to those assets and keep that business. And as you know, there are firms like Goldman that are trying to grow in the space. They just announced an acquisition in the wealth management space. So I think that it remains a really good business when you look at the financial services umbrella. And I think having it be a significant part of a major firm is a smart move. I do think protecting that high end when you have competitors like Rockefeller Global Family Office is hard.
You have competed, let's talk about Goldman for a moment. You've competed against that firm in one way, shape, or form for most of your career, what are the odds they're going to be successful in high-end wealth management?
You know, it's hard to build from a relatively small scale. If scale, and this is what big firms need to do, is what you have to achieve. So, you know, Morgan Stanley did a significant merger acquisition coming out of the credit crisis, bringing Smith Barney in, and all of a sudden you had major scale and the ability to
And
get.
it was Morgan Stanley was already two firms.
Yes, because they had done Dean Witter, but that brought them tremendous scale. So, you know, building, you know, deal by deal to try to get to scale for a large firm is hard to do. Having said that, you know, these are well-capitalized, terrific firms with a lot of talented people, and I think they'll go after it the way they go after everything, with a real, you know, focus and discipline and patience.
What other forces do you see shaping or perhaps reshaping the wealth management landscape over the next 5 to 10 years?
This is a great question, and I have a couple that I talk about all the time. One is digital, and you just mentioned it. The reason a smaller firm can compete so well in the wealth management space now is that you don't have to vertically integrate and build all of your digital. We've got terrific digital talent. Our chief technology officer, I think, is the best on the street. We partner with a number of firms, though, and he stitches it together. And because of that, we're able to offer, frankly, without legacy systems, better apps and better technology than some of the bigger firms. And that's 2019. That would have been very hard to do in 2005. And digital's key. You're going to have more and more clients that are millennials, that are Generation Z. They want to get their statement on the phone, you know, on you know, the app on the phone. They want to be able to interface with their wealth and with their client advisor in the same way they do a lot of other things. So digital's key. The transfer of wealth as the baby boomers age and leave the world, often to women as the primary decision maker around the wealth, is another major trend in the industry. And one of the things that we're very focused on at Rockefeller Capital Management is making sure that we have a diversified group of private wealth advisors, client advisors, so that we have you know, attractive options, teams that are led by men, but teams that are also led by women, even though the industry is still predominantly, from a financial advisor standpoint, male. This is an industry that should have a much higher component of its top private wealth advisors be female over time.
The nature of your business means that you're dealing with multi-generational wealth. What is it that, I mean, you talked about what the millennial client wants in the way of access to data, reporting, that kind of thing, but what is it that the millennial client wants in terms of investments, and how is that distinct from what the baby boomer has wanted, or maybe the Gen Xer wants?
The prior panel, ESG is here to stay. I'm raising 3 millennials, or maybe 1 millennial and 2 Generation Zs, but they care a lot about ESG investing and about climate change, which in their eyes there's no debate about. So this is a secular trend. And millennials and Generation Z, as they inherit the money and earn the money, are going to focus on investing along ESG standards, which is why in our asset management business, we were one of the first firms doing it, because the Rockefeller family really believed in it 2 decades ago. And in fact, impact investing was coined by one of the Rockefeller entities. So I believe, and I think you were talking about people talking about it last night, even from some of the bigger firms in the prior panel, I think ESG investing could end up being the wrapper to really all investing over time here, because there's going to be so much focus on it from younger generations.
And this is something they want, not something you're pitching them to come off as being, you know, distinctive or a leader. This is client-driven.
This is going to be, and it's client-driven today. Europe, actually, we've just launched a UCITS fund. Europe is leading the way on this. European investors, institutional investors are leading the way. But it's going to take real resonance in the US, and it'll be demand-driven. Clients, institutional, individual, high-end clients will be looking for significant ESG exposure going forward.
There's always some tension between what clients think they want and what the advisor thinks is best. Where do you see that surfacing most at Rockefeller?
You know, I think the great thing about high-end private wealth advisors and client advisors at our firm, but across the industry, the ones that do it really well, is they really care about what happens to their clients' assets. That this is they're dug in. Some of the top advisors will end up working for 30, 40, 50 years with clients. So they're very focused on what happens for their clients. So when they're faced with new things, Erik, there's skepticism, which is one reason why on the individual side, ESG has grown a little bit more slowly, frankly, than institutional, where a big pension fund can say, we're putting 10, 20, 30% into ESG size and type of investments. Whereas on the individual side, it's grown a little bit more slowly. But advisors are starting to embrace it. They see their clients being interested. And they also, ESG doesn't mean, and the prior panels probably said this, but it doesn't mean sacrificing return for investing in ESG. It's now becoming such a key part of the fabric of investing that the returns can exceed benchmarks and can exceed strategies that aren't in ESG.
Where do you see your client assets, or how are your client assets being allocated right now by asset class? We've talked in several panels today about the different opportunities or maybe challenges of public markets and private markets. So we've covered stocks, obviously, we've covered private equity, we've covered venture capital, talked about private credit. Where's the money at Rockefeller going, by and large?
Given the nature of our clients, we look to allocate a reasonable percentage of portfolios into different types of alternatives. Whether that be private equity or hedge fund or things that are complementary to the core long-only stock portfolio and fixed income. It's a volatile world today. So one of the things that our private wealth advisors and our client advisors do well is keep the client focused on what is the long-term plan and make the adjustments in response to market developments carefully against that plan. The example, it's funny, as you spend all of these different years in the markets, nobody on October 1st of 2018 was necessarily saying we'd have the kind of fourth quarter we had in 2018. And then very few people, many people had reduced equity allocation going into 2019, and you had a terrific 4 months out of the gate in 2019, and then in May you're down 6%. With that kind of volatility, the job of the private wealth advisor is to work with the client and make sure the client stays very focused on what should be the strategy over a medium-term time frame.
We're all trying to figure out how much longer this economic cycle can last. Family office capital has a reputation for being more concerned with the return of capital than the return on capital. Do you see that increasingly being the case? Are your clients growing more cautious now that there is this widespread perception that the cycle is long in the tooth?
Sure. I think there's more cautiousness on the part of clients. The only thing I'll say, Erik, is that that's been there for a number of clients for several years now. So this economic cycle has run longer than most would have expected. There's a lot of reason, there's a lot of positive in the U.S. economy and even in the global economy, but certainly here, despite a lot of the macro factors that we don't need to spend time talking about because everybody's talking about them. So the level of cautiousness doesn't necessarily mean that there's a turn coming, because the level of cautiousness was probably just as high after the 2016 election. So it's hard to call, which is why I come back to the private wealth advisor keeping the client very focused on where are we going over the medium term.
Are cash balances increasing?
I think, ironically, and I haven't looked at the data kind of week by week, but I think ironically they probably increased more coming through the fourth quarter and into the first quarter when exactly they
Only
shouldn't
to miss
have.
it, right?
And then you miss some of it, and then markets clearly turned up with a vengeance.
Here's one thing I've been wondering. Rockefeller obviously is a name rich inheritance in its sort of meaning and history in America, but people associate it with the Rockefeller family and other rich white families. How do you extend the Rockefeller brand to a place where it isn't necessarily identified with that group of people? Because it seems to me that if you want to grow your business, that's got to be part of it.
We've been, Erik, thrilled with the Rockefeller brand for our business. The family is respected across the country.
By the way, I'm not suggesting that you shouldn't be.
No, but even we just opened an office in San Francisco and hired our first team out there. I had heard, maybe it wouldn't play as well in the technology first generation part of the world. And the resonance of the name is very, very positive everywhere. And the family is known for caring about philanthropy. You look at David Rockefeller Sr., the auction of all those items that went to, the money all went to charities. They're known for supporting ESG investing. When we announced that we were doing the deal and I was taking over this firm, I have a great uncle who's 90 years old who doesn't know much about the financial world and isn't following it day to day. And he sent me a note saying, I'm proud of you for working in that job at that firm. A lot of what's right about this country is embodied in that family. I think that's the reaction to the Rockefeller name broadly across the country.
Greg, thank you very much for joining us at Bloomberg Invest.
Thank you,
It's
Eric.
great to see you as always.